Okay, this is chapter 18. This is the entities chapter that's kind of pulling all together, all the things we've added in advanced tax. We revamped a lot of things and added some nuance to some of the individual taxation issues and some of the issues that affect all businesses. But then this chapter is pulling in together the new stuff that we added in this course, which is relating to these corporations, S corporations, partnerships, and LLCs. So we're going to just go over some of the things we've already talked about and then add some more information and then just try to get a better feel for what's different about the different ones. And so the organizational form, some of this is just reiterating what we already learned when we focused on just that kind of business. And so corporations they have to be incorporated under state law. It's an entity of itself, so it has a life of its own. It's not just its owners combined. There can be or if nothing happens, you just incorporate. It would be a C corporation, which is a standard subchapter C. And then if you want it to be a subchapter S corporation, then you have to make a special election, as we talked about when we studied S corporations. And in order to do that, you have to meet certain criterion, but it's really still that same organization that has a life of its own. It's just that it's being treated differently for taxation, and it's kind of a merger between a corporation and a partnership, the way it's treated, because then it becomes a pass-through entity or a conduit entity. And then, of course, another kind of thing that people say is a corporation is a limited liability corporation, but actually a limited liability corporation and a limited liability partnership are both just really limited liability companies. And so they aren't actually technically corporations the way we think of corporations. So you do file forms to create a limited liability company with the Secretary of State, but or with some form of some department of the state, and that you're operating in, but it's not an articles of corporation. It's articles of organization. And so that would be, some people think of those as corporations. They aren't actually the classic corporation that we think of. And then other than corporations, there's partnerships. It can be an informal organization. They can have legal documents, of course, and they often do, but they don't have to be documented like that in order to be still legally a partnership. It's just a combination business where multiple owners own it together. If you want to be a limited partner, though, you have to file the state form to be recognized as an LLP. And so it could be a partnership, can be a limited partnership, an LP or an LLC or an LLP, which means limited liability partnership or limited liability company, limited liability corporation. And so all of those are treated like partnerships for taxation purposes. And then it could be a general partnership, which means there's no limitation on the liability of the partners. They equally share. And then, or at least they share by their ownership percentage at the very least. But there's not a limitation on the liability that outsiders could assume that they hold about the partnership. And then there is sole proprietorships, which is just a single person entity, just like a mom and pop shop that opens up a business. It's an informal organization, does not generally have any kind of organizing document. And then non-tax factors that affect these different organizations. The liability is a huge one. You know, when I'm even trying to describe the different kinds of entities, I'm talking so much about liabilities because that is the major difference. That means you want to have a corporation or you want to have an LLC. It's the fact that whether you're going to get the limited liability for the investor. And so that is a big concern. Owners can still be liable fully, even in a partnership or a sole proprietorship. So that's why a lot of people use one of the other forms of business. Also, the shareholders or the limited partners can still be liable in many states for their personal actions. So what you're getting is you're getting limited liability for the organization's obligations, not actually for the obligations of your own personal actions. So if you're a lawyer or a CPA and you work in a corporation, classic corporation, or a limited liability company, you are not responsible for what everybody else in the firm does. Or if someone gets injured on the property, you're not responsible for those kinds of things if you have limited liability, but you are responsible for your own professional behavior. So you still can't get away from that liability by being a different kind of organization. That is in most states. I don't know of any states where you can use the corporate shield to protect you from your own misconduct. Okay, and then the rights and responsibilities are different in every state about what organizations are responsible to do. And so you have to make sure you understand your state's law about that. And then capital formation is different amongst all the different entities, but mainly the biggest difference is a C corporation is the only one that can issue shares and trade the stock on a national exchange, a public securities exchange like the NASDAQ or the New York Stock Exchange. So, and they can do what's called an IPO or an initial public offering, where they offer to sell pieces of their company. And so a corporation is required in order to be able to do that. And then a limited liability company and a C Corp a lot of times are more favorable for the same reason we've been talking about. The lower liability is one, and then a strict limit on liability as far as only the part you've invested is at risk. And the second one is it obviously involves less involvement if you're not the general partner. Okay, and now the entity, these are general differences between the entities, and those are pretty much the same that you would learn if you were in a B law class and they were talking about the different entities, because that's what it is. That's not specific to tax, but it is pertinent to us. And then the next thing is the taxation part is just what we do have the primary responsibility to take care of. All this piece right here that we're looking at is about the C corporation. So here's some factors about the C corporation that we need to know as accountants to make sure that we get it right. So one thing is a C corporation is a tax-paying entity. Whatever bottom line income they earn is generally going to be taxable. It's not going to be taxed to the owners. It's going to be taxed to the entity. Whatever profit they wind up with after they pay their expenses, they owe tax on it. It's taxable income. They calculate their tax. The corporation pays it. And then if they decide to distribute some out to the owners, that's a different issue. That would be a dividend they would be paying out. And so we'll talk about that in a few minutes about when we get down here a little further. But so the first thing is they are a tax-paying entity. They file a tax return, the corporation does, on a Form 1120, and they report the income and all the deductions. They compute their tax on that form, and they pay it as the organization's checkbook is where they pay it from. And another thing about corporations, that you can have an unlimited number of shareholders. And the tax year can be whenever the corporation chooses to put it. They don't have to agree with the tax year of the investors or anything like that. They can decide what month they want it to end in. And the other thing, large corporations can use the accrual method if they like. No, sorry. Can use the cash method if they don't have too much income. I'll get it right in a minute. The large corporations must use accrual because the only ones that qualify to choose between cash or accrual are the smaller corporations, which means less than 25 million of gross receipts or income sales. And then it's not net income that has to be less than 25 million. It's their gross collections, or not collections, I'm sorry, gross sales. And then the next thing, partial service companies must use the cash method, and they are subject to the highest tax rate. Well, now, right now, everybody's tax rate is 21% if they're a corporation. So the partial service corporations are not feeling any pain from this. But if the rates ever go to a graduated rate, then the partial service corps would be subject to the highest rate that's out there. And in the past, we have had to deal with that. If there's income left in the C corporation and it's like a law firm or an accounting firm or an architectural firm, then anything left in the corporation and not paid out as salary to those people doing the personal services, would be paid at the highest corporate rate. So still 21% right now. And then the next thing, QBI, the qualified business income deduction, is not available for corporations. So there's going to be a problem that in some of these chapter exercises where they ask you, what's the difference if we're a corporation or for an S corporation or maybe for a partnership? And so all the other entities can use the QBI, or qualified business income deduction, which is that 20% of basically 20% of the bottom line of the business, of the productive part of the business is, it's got some limitations because we've already dealt with that in every tax class. But just knowing that, you need to look it up, the QBI, if you need a refresher on that. But for now, know that all the other entities can take this QBI deduction, and it generally amounts to 20% of the bottom line of their business income minus expenses. And then corporations, though, are not allowed that deduction. So when you're doing a comparison, that has to be factored in. Now, the next one is owner distributions or dividends in a C corporation. When you give a distribution out, it means it's going to be taxable to that owner, that shareholder. And it's not a subject to Social Security or anything like that. It's just taxable. So when it's paid out, it's not a deductible expense to the corporation. It's dividends, which is not deductible. And it is reportable, though, to the owner. So that's where you get into that double taxation, which we'll mention some more in other parts of this chapter. And then I mentioned that the distributions or dividends are not subject to Social Security or self-employment, but their salary is, of course, because anytime you pay salary, the corporation would be paying Social Security tax, and they would be withholding Social Security tax. So that any salary that was paid out would be subject to Social Security, but not the dividend part. All right, so that's just an overview of the tax situation with the C Corp. Now the S Corp, see how it different. S Corp was a former C corporation every time. They made an election to be treated more like a partnership, which means they became a flow-through or conduit unit. And that means that whatever the bottom line share of the income is, the bottom line income for this company, whatever that shareholder's part is, will be reported to them on a Schedule K-1. So the S Corporation files a Form 1120-S to report all the revenue and all the expenses, and then they summarize all these things on Schedule K, and then that Schedule K is the total of all the investors' Schedule K-1s, because every time they threw something over to the K and said, this is the net income from the operations, and this is the contribution, charitable contribution. So this is the interest income. All the different separately stated items that would show up on a Schedule K for the subchapter S corporation would then be split out to each owner depending on their share of the stock. And so that split out comes out on the Form K-1. So if you took all the K-1s and combined them, it would bring you back to the exact same numbers that are on the Schedule K for the Form 1120-S. Okay, so the tax is computed not on the corporation at all, just because it's a conduit. The tax falls on the individual shareholder. So when that shareholder gets the K-1, they include the income that's reported there and the expenses on their personal return, and that determines what the tax is going to be for them. The corporation doesn't even know what tax brackets they're in, so they couldn't possibly compute the tax for that shareholder. And then the number of shareholders can be anywhere between 1 and 100. So it is limited in the number of people that can be shareholders, or the number of shares of stock that could be issued to different people. But there is one caveat that's not mentioned here, but we did mention it in the S Corp chapters, that remember the family members, related parties are not separated for the purpose of this maximum 100 shareholders. So if you had a family that were 25 people in that family, then they could all be considered as one shareholder in order to get your number of people that are investing in this corporation up some. So 100 shareholders means even with each shareholder counting could include multiple people that are in a related party situation with the family. Okay, then the next thing, shareholders can't be corporations, they can't be non-resident aliens, and they can't be partnerships nor trust. So they need, basically the shareholders are individuals most of the time in an S corporation because they can't be these other entities. And the tax year agrees with the owner's year. And if they don't all have the same year, meaning they mostly have calendar years, but if they don't all have the same year, it would agree with the majority of the taxpayer. So if you happened, this is very rare, but if you happen to have a shareholder that was on a fiscal year end that had a majority share, then your S corporation would need to go to a fiscal year also that matches that majority shareholder. But most of the time, you could take every shareholder and look at their year end, and you'd still be at the calendar year. And even if you had someone who was fiscal year on an individual level, which is very rare in itself, but if you did have someone, it's not likely that they're going to be the majority shareholders that have this fiscal year. But if they did, they would control it. The exception to this owner's year would be if you had a natural business year that was clearly indicative that it would be better to report and more accurate to report on a fiscal year. So this would be like if you're a Christmas store, you can't really argue for a natural business year that's different from December 31st, right? Or if you're any retail that relies heavily on your Christmas season, same thing. Natural business year, perfect for calendar year. But what if you were a Mardi Gras supply store? Maybe your fiscal year doesn't agree with the calendar year. And so you could probably argue for a natural business year that ends in April or something like that. So anyway, but most S corporations are on calendar year because their shareholders are. And you can choose cash or accrual, but of course, you never go cash if you have inventory because you have to at least go modified cash in order to account for the inventory on the accrual basis. And then QBI is available. The qualified business income deduction can be taken on S corporations. And then the next one that's just a little random thing I have here, and I put it in because there's going to be some problems that are going to ask this. And this is something we learned in that chapter. It's just that now we're looking at it from the standpoint of what's different about each of these entities. And this pops out that, hey, this is one of the differences. And so S corporation loans that are guaranteed do not increase the shareholders' basis. So on partnerships, if you are a partner and you go sign the line on a note, you're going to increase your basis by the amount of extra liability you just took on. And so that is not the case with S corporations. Sometimes the S shareholders do guarantee loans at the bank because a lot of times these are small businesses. And the bank requires a person, not a corporation, an individual to sign the line. And so if that happens, it does not increase the basis for that shareholder if they're an S corporation. And so all the other ways that you increase or decrease your basis are almost identical with an S corporation and a partnership, but not this one. They don't get credit for the debt they're helping secure. And then owners' distributions are not subject to Social Security and self-employment. This is another difference between partnerships and S corporations, and it's a pretty big one. And that is that when you get a distribution when you get your share, it's really not the distribution so much, it's the distributive share. The owner's distributive share, it should say right there. I'll just change it. Oh, if I could spell, it would help so much. Are not subject to Social Security and self-employment tax, even though a partnership would be. So when you get a salary from an S corp, you are subject to Social Security. But whenever you get a further share from it, you don't get when you get your share of the profits of an S corporation after the salaries have been deducted, there's no Social Security assessed based on that. And so then the other thing is the owner's distributive share percentage is determined by their stock ownership percentage, meaning it can't be different. The profit and loss percentage won't be different from the ownership percentage. So these three last things are the things that are different about partnerships and S corps. They do not agree with partnerships. Partnerships are exactly the opposite of these three things. Okay. All right. So let's go to partnerships then. Partnerships, and by the nature that they are considered partnerships, multiple member LLCs and LLPs are treated the same as a partnership. So even if it says limited liability company, it's still going to be taxed as a partnership. It's a flow-through entity, tax to the owners, much like we just discussed with the S corporations, but it's not a corporation, it's this partnership. So it files, instead of 1120S, it's going to file a Forms 1065 to report those same income deductions, also have a distributive share summary, which is the Schedule K, and that's going to show how much profit loss was reported in the business. Maybe if they had some rental real estate, it would show a line item for the bottom line profit or loss from that. Then it would have interest income. It would have gains and losses that were separately stated. It would have charitable contributions and lots of other things, just like an S corp could, that would show separately stated items that are going to be split out amongst the partners. But it's just going to all show up on this Form 1065. The partnership won't pay tax on it. They will just be a reporting entity. They're a conduit that's going to dump it out on the Schedule K1. Then each individual shareholder will have a piece of that reported on their K1. So that, again, if you took the K1s and added them all together, they would equal the Schedule K that's showing up on this 1065. And so the individual partners are responsible to pay the tax on their individual share, and they're going to blend it with their other income and expense. And that's how they're going to decide how much they owe based on the tax bracket they're in, plus the laws that control whether or not they are allowed each deduction or how much of the revenue must be reported. So that, again, the partnership wouldn't know whether the partner is going to be taxed at a certain rate or not, because they're not privy to everything that's on the partner's tax return. They just know what happened in the partnership. And then the limitations, there can be unlimited number of people in the partnership, but it just can't be less than 2. It must have at least 2 people to be a partnership. Otherwise, it would be, if it just had 1, it would be a sole proprietorship. So the number of shareholders can be anywhere between 2 and infinity or unlimited. The tax year agrees with the owner's tax year, the majority, and that's obviously makes sense because these are individuals that are the owners. The tax year, they can choose the cash or the accrual method, assuming that they don't have inventory. If you have inventory, you're going to normally go with the accrual method, or at least for the inventory, you go with the accrual method. The QBI is available. You can take the qualified business income deduction. And then partnership loans that are guaranteed increase the partner's basis. So when a partner signs a line, just like we talked about the S corps, that it did not do this, when a partner signs a line at the bank, they get increased basis because of it. And then the other 2 things that are different from S corp is an owner's distributive share. It's too bad that I didn't have it in there, right? It's close to the same thing, but it's just not the same thing. The owner's distributive share is subject to Social Security tax or self-employment tax, as it turns out. Social Security is what you do for wages, and self-employment is for contract labor or self-employed income. And the owners and partners' direct payments for salary equivalent, which is called guaranteed payments, are also subject to Social Security through the self-employment tax. And so really, when I refer to Social Security tax, I'm talking about FICA and Medicare. And they really are both effective for an employee and for a subcontractor or a partner, but the difference is they just don't refer to them the same way. When they say the self-employment tax, they're talking about both sides of Social Security. So the employer and the employee part has to be paid by the self-employed person, but it's still the same tax. Okay. All right. So then the owner's distributive share percentage can be different in the by the partnership agreement stating it so can be different from the profit and loss percentage. So the distributive share or the profit and loss that they get can show up differently than their ownership percentage. So that's different, the different methodology of allocation than the S corporation has. So I've seen some very creative partnership agreements that show ownership percentages at 1%, and then percentage for profit at another percentage for loss at still another percentage. And that is the reason a person might want that is if they're in a high tax bracket, they might want to take a low percentage of profits as far as reported to them, and a high percentage of losses that can offset some other income. And then their ownership would be in reality, what they really owned of the business. So if everyone is in agreement, and that partnership agreement has to be signed by all of them. So if the partnership agreement states that it's okay to split all these profit, loss, and capital in these ways, then it can be done. So then the next one, now there could be some limitations, because if you really dig in deep to partnership law and partnership taxation, it could span multiple terms of study. So a lot of accounting programs that have doctoral programs or master's programs will take a partnership course and expand the information, expand the nuances to cover entire terms, because that's how much detail there is. So when I'm talking to you, I'm giving you generalizations many times. So, it's not like you can take to the bank all the generalizations, that they are 100% always applicable. But as a general rule, these are the way, this is the way that it works. All right, sole proprietorship, the last one. A sole proprietorship is just an individual that goes into business. They're going to show it on Schedule C, or if they're a farm, they show it up on Schedule F. And the interesting thing that most people don't realize is that if you have an LLC that is a limited liability company that has only one member, it has to be treated as a sole proprietorship for tax purposes, not as a corporation, and not as in the partnership returns like the other LLCs, but as a sole proprietorship. It is a flow-through entity. It's taxed to the owners. It doesn't have a life of its own. Even if it's just a regular sole proprietorship, it is still considered a flow-through entity. It's just flowing onto that person's return. It just goes on the Form 1040 as a Schedule C or F. And the owner's share is added to their other personal income just to see where it's going to land and what the tax rates would be. The tax is computed on the owner's respective for 1040, and the tax is paid there, not from the business. The business is the owner in these cases. It's limited to one owner. Tax year obviously agrees with the owner's tax year because it is the owner. And then you can choose either cash or accrual, assuming no inventory. If you have inventory, you at least use an inventory accrual for the inventory. And then the qualified business income deduction is available. And the other thing is the owner's distributive share is subject to Social Security and self-employment. So whatever the bottom line on the Schedule C or the Schedule F is, it's going to be taxable for Social Security. That means self-employment. All right, so here's one thing that hits C corporations only, and that is this double taxation. Okay, so after tax earnings, when it's distributed, what happens is the corporation pays tax on the profits first, every year, whatever they make. And then the shareholder, when they get the distribution of a dividend, they pay tax as a dividend. And so if an individual gets dividends from a corporation, they get preferential treatment by 15% tax rate on dividends received by the qualified dividends provisions. And then the corporations that are shareholders of other corporations get what's called a dividends received deduction that provides a similar benefit, which helps them avoid some of that second level of tax. Doesn't eliminate double taxation, but that's why these two provisions are actually in the law, is to try to mitigate some of that double taxation problem. All right, and so another gotcha that might happen, and we talked about this in the corporate chapter, is on a C corporation, you might have an accumulated earnings tax. There's a potential for that. That's not on any other kind of business. And then same token, also 20%, but a totally different tax. The personal holding company tax hits only on the corporate level, also on the C corp level. So these are also two more gotchas that could hit a C corporation that don't cause a problem for other organizations. So to mitigate the double tax, some people look at it and say, what can I do? Especially small corporations where you have just a couple of owners or just one owner. A C corporation that is trying to mitigate the tax could, for one thing, if it's a service corporation, they're trying to avoid that maximum tax rate that happens even when they're graduated rates, and the max rate is much higher than the lowest rate. The max rate is what's charged on these personal service corporations. So one of the things that has been done over the years to try to lower this penalty toward corporate form, a C corp form, is paying the profits out of salaries to the shareholders rather than letting it go out as a dividend. And so it has to be a reasonable compensation. So if you can show that the compensation matches the effort and expertise that's provided by the person you're paying, you won't have a problem supporting your salary numbers being high normally. Or if you can find comparable salaries somewhere in the US for the same type of work, that helps too, to legitimize a high salary. But if you can't calculate it as a reasonable compensation, then you just have to stop. You can only take salary up to a reasonable compensation. And then the next one, you can increase fringe benefits to the shareholders and employees, but only to the extent that it's reasonable. Again, you can't give them something that is not okay as far as a legitimate fringe benefit. But you can't explore all the fringe benefit options that are out there and try to maximize them. Another thing you can do, if the shareholder is providing some part of the facilities, then you could possibly assess the lease payments that you're paying to them, and make sure that you're paying them the maximum amount of rent that's reasonable for the property that you're using. And so that would be done by comparables in the area. It doesn't have to be that you are the most reasonable rent, you're paying the most reasonable rent to them. It doesn't have to be that you're the average rent. But if your rent is within the range of the norms in your area, meaning if you look at the low rent places and the high rent places, it's okay to pay on the high rent into the scale, as long as you have some comparables that say, oh, other people, especially in this type of business, like I have dealt with a lot of doctors over the years. If your doctors, you can find comparables for other doctors that paid high rent for their location. That's going to help you legitimize your high rent. And that might lower some of the double taxation, because if you're paying out any of these things we're talking about here, it's a deductible cost to the corporation. And it's still going to be a revenue to the individual, but at least it won't be doubled where the corporation can't deduct it and the individual has to pay tax on it. It's going to have to be paid tax on whenever you pay these extra salary. If you pay fringe benefits, some of those it might be, but mostly they might not be. And then leases, that rent would be have to have tax paid on it at the individual level, but it would be deductible to the corporation. And the last one, if you're borrowing money from shareholders, which oftentimes in small businesses, rather than going to the bank, the corporation would borrow money from its owner. And if that happens, you could add interest to it, and that interest would be deductible to the corporation many times if it's a legitimate business loan. And it would be reportable as income to the shareholder, but it wouldn't be a double taxation problem. Again, it would still have to be accounted for properly, and it would be recorded as revenue between the two, an expense to the corporation and a revenue to the individual. But it wouldn't be something that was paid out as a non-deductible dividend, and then it still had to be shown as income to the shareholder. So anyway, that's just some ways to try to get around that. Legitimate ways to try to get around that double taxation. All right, so now converting to other business units. in business types. If a proprietorship wants to change to one of these other entities, it is so easy to do. That is not a problem. You have to have you're going to pay some legal fees. You're going to make sure you get some record keeping in place, but it's not a huge leap to move from a proprietorship over to one of these kind of businesses, the partnership or the S Corp or the LLC or the C Corp, any of the four. So those are totally doable. And then a C corporation can convert to an S corporation if they meet the rules for the S corporation entity, which we know is 100 or less shareholders and quite a few agreement by all the shareholders, a lot of things they have to jump through hoops, but it's doable. And so they can, if they can get the agreement, but there could be some tax effects going from a C corporation over to an S, as we learned when we were in the chapters for S corporation. We saw some built-in gain and things like that that can carry over from a C corporation that you have to be careful about, but it's not that it's prohibited. It's just that you have to be cognizant that you're moving these assets, so there might be a built-in gain attached to them. And then the other one is C corporations can just liquidate and reorganize as another entity, like a proprietorship, partnership, or an LLC. Now, I didn't say tax-free, because when a C corporation liquidates to reorganize, they probably will have to pay tax on that liquidation. So I'm not saying that it's without consequence. I'm just saying it's totally possible if you want to change your form of organization. And then a partnership can be converted to a corporation relatively easily just by rolling the assets in to the corporation. And there could be tax ramifications, but many times there are not. And so it would just depend on the situation and what kind of assets and liabilities we're moving into the corporation from the partnership. But in any case, you're not locked in forever in the certain form of organization if you just totally do not feel that it's the right thing for your company. Now, the next thing, deductibility of the losses. There is a difference between the deductibility and the different companies and different kinds of companies, of course. Corporate net losses, in other words, the C corporation losses, NOLs, cannot offset the owner's taxable income, obviously, because that C corporation is an entity of its own. It's totally separate from the owners. So when you have a C corporation, if you have a loss there, you cannot share it with your shareholders. Share it. You cannot just give part of it to the shareholders, obviously, because the C corporation doesn't have conduit ability, right? So an NOL in a corporation can keep moving forward indefinitely. But if you never have any profits in that C corporation later, it won't be utilized. So it needs a profit at some point in order for that NOL to be able to offset the profit, to be able to get the benefit from it. That's if you're a C corporation. If you're any kind of pass-through entity, that's not the way it works. In a pass-through entity, if a loss happens to the business, it pushes straight out to those individual shareholders, and it can offset their other taxable income, with the caveat that you still have to be cognizant that you have to make sure you have amounts at risk in order to take losses. And you have to make sure that when you're dealing with passive activities, that they can't offset active or portfolio income. So the passive loss rules and the at-risk loss rules still apply, of course, every time in every transaction that you do. But when you have a pass-through entity, those rules could stop you from getting a loss. But just the fact that it came from a pass-through entity like a partnership or an S corporation or an LLC would not prohibit you from deducting against other income. It's only these passive loss rules and the at-risk rules that might stop you. So you have to assess those, make sure you're cognizant. All right, transfers to an entity. This is kind of a refresher because we already talked about these in each individual, how it would work. But this is just to pull it together. The sole proprietorship, not a taxable event when you're moving it into an entity like a corporation, but because the ownership's not changing, the basis continues. So if you put a sole proprietorship asset into a partnership or into a corporation, I'm sorry, no, I messed up. That's not what they're talking about. If you put your personal assets into a sole proprietorship, it would still carry over the basis because you're not changing the ownership at all. It's still going to be a personal interest. And so that's the moving assets into these kinds of entities. If you're moving assets from an individual into a partnership, it's normally not a taxable event. They're either, if the assets are exchanged for a partnership interest, the entity's basis would just carry over. It would be the same as it had been in the hands of the partner. And then the part, as you know, there's some exceptions. Well, not really exceptions, because we're talking about property. If you do donate services instead, now the rules are going to be different, because services is going to not going to be taxed the same way. It has to, in order to get any basis from providing services, you would have to be taxed on the services. But in any case, that is a different issue, and we covered that in the early chapters. But normally the assets transferring in exchange for a partnership interest is not a taxable event. And the partnership's basis in the partnership share, this is just a reminder from what we learned when we were in that chapter about partnerships. You start with that carryover basis that was first contributed. And then if the assets that you transferred into the partnership, if the individual had a loan against those and it transferred in as well, then that would reduce the basis that is moving into that partnership. So if you had a loan, if you had a property that's worth or that's carried on the books at 100,000 and a loan against it for 60, then the net that you're putting into the partnership is just the 40. The total, the carryover basis minus the debt that you just were released from. Whenever you're released from a debt personally, and the partnership now has that debt, then that means you transferred only the net amount over to the partnership. So that's the combo of these first two. And so it's too bad, it grabbed too much for me. And then the next thing you would add is the partnership debt that was allocated to that partner. So we talked about this a moment ago. If an individual partner is liable for part of the partnership's debt, then they add that to the basis, which is not the case for S corporations. They do not add debt that they have, that they're responsible for to their basis. And then if you had any kind of transaction, which is rare, that was taxable on the partnership, on transfer into the partnership, then that any gain that you recognized or service revenue, then that would increase your basis. And then another thing to note is the holding period carries over with the assets contributed. If there's section 1231, which means the business assets. If it's a business that's operating and you move those assets into a partnership, then the holding period is still going to be those longer termed, whatever your basis, whatever your beginning holding period was the day you walked in there, that's going to carry over to the partnership. But if it's not a 1231 or business asset, then the holding period would start the day the partnerships, your partnership interest started. First, corporations and S corporations, because S corporations are corporations, aren't they? So for corporations, when you transfer assets into the corporation from an individual, it's not a taxable event if these two pieces are in place. One is if the assets are transferred solely in exchange for shares. And two, if after the transfers are made, the transferors control more than 80% of the stock. And so that means when you're doing a big transfer, multiple people, the initial incorporation of assets, it's a lot of times not a taxable event. And this is that code section 351 transfer. And then the entity's basis is the same as in the hands of the shareholder. Plus, if there was any gain that had to be recognized, that would increase the basis as well of the assets of the entity's basis. And then the shareholder's basis in the stock would be the same as basis in the assets they transferred, plus the gain they had to recognize on the transfer. So if you had that services thing coming in here, that you contributed services to get your shares, you would have to pay tax on the services you provided, and that would become part of your basis of the stock. There's no adjustment here for entity liabilities because this is a corporation or an S corporation. And so it's not from the standpoint of the entity liabilities, it does not work the way partnerships do. That's something to make sure you note. Okay, dispositions now. That was when you acquire your ownership of the entity, transfers to an entity. Now here's the dispositions from an entity. If it's a sole proprietorship, the assets you distribute from a sole proprietorship are treated just like individual assets because you own them personally. It's not no middle ground organization, just you own those assets, even if you're operating as a grocery store, convenience store, hair salon, any of the small businesses that you could do, or a farm. Those assets are actually your individual assets. That's how you treat them for dispositions. Now, if you dispose of a partnership, if the assets are distributed out to the owner, then they're treated the same as sale of individual assets. So you would just sort of, just like your proprietorship. But if the ownership interest is sold, so in other words, 3 people own this partnership together, and one of them sells their ownership, they're part of the partnership, back to someone else or to one of the other partners, then that partnership interest is treated as a capital asset, and it gets capital gain treatment on everything except what's considered these hot assets. And that's, again, it's a very complex concept, but it basically just means the assets that would have to be shown as ordinary income rates rather than capital gains. So most of the time, an ownership interest would be at least part of it would be a capital gain asset, but the assets that would have sold as ordinary income would need to stay as ordinary income. So, like if you were the inventory or some other asset, that it would be obviously an ordinary income property. Okay, and that's partnerships. Now, corporations, if assets or cash are distributed, double taxation is going to happen, which that's always the way with distributions in a corporation. But the reason it's triggered is that whenever a distribution is made from the corporation, it's assumed to be a sale of the assets for their fair market value. So when so the corporation recognizes the income for the fair market value minus the basis, and then the distribution comes out and the individuals are taxed at the fair market value of the assets. And so if you sell instead the corporate stock, no double taxation is happening, because the shareholder gain is just the difference between the asset they just got at fair market value, or if the corporate stock is sold, basically the shareholder gain is if the proceeds exceeds their basis in the corporate stock, because they already had their basis when they invested it back here when we talked about putting into the corporation. So if they sell the stock back to the corporation or to some other individual, and they actually get cash for it instead of assets, then they'll just have a clean difference between their original basis and the amount they just sold the stock for, and that's their gain. Okay, and that would not trigger a taxable event in both places that would require double taxation. S corporation, if the assets are sold, then a pass-through would happen, of course, because any income that's reported to the S corporation is shared by those investors. And so because the conduit unit's there, the pass-through would mean everybody would take a share of that distribution of that amount of the gain. And then instead, if they distribute the assets, the pass-through would still happen, because the income would be recognized as if there was gain in the transaction. So if the fair market value is more than the book value, if assets are distributed in an S corporation, then the S corp has to show the gain and pass it through. And then if the corporate stock's sold, a shareholder gain only happens, again, just like it did in the C corporation, if the proceeds exceed the basis in their corporate stock. So little extra complication here if you distribute assets from an S corporation, in that it still works the same way, but because of the pass-through, it's you might as well have the S corporation sell them instead of distributing the assets directly to the shareholders, because the effect becomes the same. Or at least that's what it seems to me. Unless I'm missing something. I think so. Now, that's not if there's a loss. That's if there's a gain. There's a good concept summary in the textbook. This is in chapter 18, the concept summary 18.2. It shows so many nuances amongst the different organizations and how would that be different. The comparison of them, it goes for pages and pages. This is in the Nellen Tax Essentials of Business Taxation. Chapter 18, concept summary 18.2. So I suggest you spend some time with that, and that's going to hopefully help clear you up, and don't let it freak you out, okay? Okay, so we're gonna go ahead and stop this share.